Say hi. Sorry.
That's all right.
Yeah,
Everybody,
I can hear you.
okay, good deal. All right, so we've got a few in the room here and a few on Zoom. Guys that are on Zoom, forgive me. This is actually my first Zoom meeting, so I'm not looking at the camera and doing a bad job. I apologize, but hopefully what you'll see on the screen is what everybody else is seeing up on the screen here. So I do know Michael is watching the chat. So if you have questions while we're doing this and you want to ask, please do. We'll do questions as we go. That goes for you guys too. There's no need to wait until the end. This shouldn't take too long, but I want to make sure everybody understands the whole process before we go. So I'm going to back up a little bit and tell a little bit about myself so you guys know who I am. As it says on the screen, Brent Adams. I've been in the mortgage business for just at 20 years, which ages me a little bit. So I've got a lot of experience with a lot of different kinds of loans, from debt consolidation loans. I specialized in VA for about 3 years, where I did nothing but VA, and done just about every other kind of purchase loan, from rehab loans to everything else. So I've done a couple of them. Let's see, Move Home Nevada started early last year, and I was the loan officer that they hired to run the company and get everything started, and it's been going fantastic. We are growing every single month to the point now where I think this month we're going to close, I think 5 or $1.4 million. So thank you guys. Been pretty steady growth. So I'm going to go ahead and get started. And for those of you who don't know where you're at, this is Mortgage 101. So as my professor always said, if you're in the wrong class, you need to leave now. All right, so first one, we're going to go over the roadmap. We're going to go over where from start to finish in this class. I'm also going to review some of the programs and things like that. We'll start application. That's the easy part. I speak to your client, they fill out the application, then we move it to underwriting. The underwriter reviews it, hopefully approves it. When they do, I'm going to talk about this piece right here quite a bit, and that is conditions, guys. In box number 3, for those of you guys on Zoom, we're going to talk about conditions in the loan quite a bit. Processing, the underwriter and processor, we're going to work on getting those conditions, and then closing. Once all the conditions are satisfied, that's when we're going to move to closing, which is the best part for you guys. That's when you get paid, right? All right, so I'm going to go over the loan programs just very briefly, but stop me if you have any questions. I also have a flyer here that has them listed for you guys that are out of town or anybody who's on Zoom. I'm happy to send this flyer to you as well. It's basically got the information that we're going to talk about here. We're going to start with FHA, Federal Housing, VA, USDA, conventional. Now, conventional, I am going to clarify, there's 2 different ones here. There's conventional, which is qualified mortgage, and non-qualified mortgage, jumbo, non-traditional, and income and credit. There are very few companies out there anymore that do a lot of non-QM loans and non-traditional loans. They are out there, I will tell you that. That's not what we specialize in. If you have clients that need that type of loan and we find that out throughout the process, I know a lot of lenders in town that I can refer them out to. No, whoops, did I do that?
Nope, I didn't. Sorry.
Jumbo loans, we do, and we do well. I will tell you that much. I actually looked at pricing on jumbo loans today. Conventional was 3 1/4. I'm sorry. Jumbo was 3 1/4. Conventional was 3 1/8. And if you've ever done a jumbo loan before, usually the rates are about 0.5% higher. Right now, everybody is wanting jumbo loans, so they seem to be performing better. So a lot of companies are pricing them really, really well. I'm not going forward now for some reason.
Oh, try it now.
There we go. All right, so let's start off with FHA. FHA is created by HUD to provide low down payment. Minimum down payment for FHA is 3.5%. One thing that's unique about us is we go down to a 580. There's a lot of companies out there that require a little bit higher score, 620, 640, 600, depending on what their taste for that is. We can go down to 580, and I've actually done one at 582 for a client, so we can get them that. They do have higher debt to income ratios. Non-occupant co-borrowers. So if you've got somebody who wants to buy a house, but they need somebody to co-sign for them, their parents can co-sign for them. That's one of the beautiful things about FHA. Now, here's the downside. Mortgage insurance premium is significant. It's 1.75 upfront, which they do get to finance, but it's 0.85% of the monthly for the life of the loan. It does not matter how long they keep the loan, it is that for the life of the loan. It's not going again.
Did you say we could ask questions?
Absolutely.
Can they hear us?
I don't know, but I'll repeat the question in case they cannot.
So if someone gets a FHA loan, they can refi in a couple of years to
Absolutely.
get rid of that mortgage insurance.
Yeah, I've actually done 3 refis in the last 2 months out of FHA loans. The question was, can they refi that loan? And absolutely, at any point in time, there's no prepayment penalties whatsoever on any loans anymore. So you definitely can refi, especially with the way houses have been increasing in value and equity has been increasing. It's recommended if they can get into a house in an FHA and know that in even 6 months to a year in this market, they may be able to refinance out of that loan. Now, there is cost associated with the refinance, so you have to weigh that, but usually it's still beneficial. VA loan, or just what it sounds like, veterans, they can go 100% financing. One thing the VA did change last year is there is no limit on that financing. They can go up to $2 million if they qualify for it. There used to be a conventional loan limit, so they definitely improved that situation. One of the things that I hadn't done, but knew it was possible that I love now is this bottom one. Veteran can get more than one VA loan. I'd always seen that guideline and I'd never done it, and I'm actually doing one right now for another veteran. They have to put some money down, but it's still way more beneficial rate wise, and there's no mortgage insurance as far as doing a second. So it's a great deal.
What kind of, can you go into depth a little bit more on that? I have a client right now, veteran, who's thinking about selling his townhome and moving across town kind of.
Yeah.
He's worried about, doing a contingent and have a place to move,
Right.
essentially. What kind of down payment is required for that second?
So that's a great question, Torrin. It actually the question was, what kind of down payment is required on a VA loan for the second loan? It really depends on how much of their eligibility is available. And I don't mean to answer that kind of and not answer it, but there's an actual calculation. So the best thing to do in that situation is let me talk to him. We'll pull up his eligibility, see how much he has used, and then we can do the calculation right then and there. In my borrower's case, he's putting on a $300,000 house. I think he's putting 13,000 down. So it's not a huge amount most of the time if there's some eligibility left over. But in that case, it just does depend on their eligibility. There's an actual calculation sheet that's interactive. Yep. Okay. Any other questions? All right. Next one, USDA. It's rural. Now, the thing about USDA that is a hard one to overcome sometimes is 50% debt to income ratio, household income caps. So the difficult thing, especially here sometimes, is I can't get somebody qualified because they make too much money for the house that they want to buy, or they don't make enough money, and then we're looking at a debt to income ratio probably over that 50%. So it's kind of a balancing act with USDA. In this market, we can still do the loan, and I've done a couple of them. Hey, Troy. But it is a little bit more difficult. Again, the nice thing is down to a 580 minimum FICO.
Brent,
Yes, ma'am.
I know we have people across the country,
Yeah.
but are you able to quickly tell us what areas here would qualify?
Anything
Like
outside of
Early,
Reno.
Fallon, and Carson? Carson
Anything
would qualify.
outside of Reno proper almost.
Okay.
I can actually get you the map if you would like. You get up in, I believe Cold Springs, Fernley, Fallon, anything out there, anything outside, basically.
Isn't the Rabbit Toll Road, isn't that still part of it?
I don't know, Tori, I have to
Little
look at
section.
yeah, it does kind of wind in some sections, as long as they haven't redone the map to where it's still considered rural, yeah, it definitely does. But I can actually send you a copy of the map about that. Remind me of that though. Conventional loans, it talks about non-government insured loans, although there's a lot of government oversight, and it talks about Dodd-Frank here. Dodd-Frank is what happened in 2008 when the mortgage crashed, and the CFPB is in charge of all of the mortgage regulations. Now, a lot of Dodd-Frank has been repealed, which has helped quite a bit because some of the regulations were so strict. It was very difficult to get loans for those of you guys who've been in the business for a while. You know. The debt to income ratio, it says 45%. I will say I get the automated system approving well over that, almost to the 50% range on a regular basis, depending on compensating factors. It does have mortgage insurance, but that's determined by credit score and down payment. So there's not an actual calculation that we can just say, oh, it's going to be this much. Credit score greatly affects the rate of DTI allowed, just like I just said. Jumbo loans, anything exceeding in our market 548, 250. Not sure what other markets everybody else here is in, but that's pretty common across the nation. California and some of the East Coast places are higher than 548, 250. Says higher rates, but as we mentioned before, that's not necessarily the case right now. There's a big taste for jumbo product because it performs well in the market. Down payment is usually 20%, fixed and adjustable. Right now, rates are so low that adjustable almost makes no sense. I mean, you could take a 2.5% adjustable or a 3% fixed. You're probably going to take the fixed. Non-QM loans, again, we talked about those. Not my specialty, not what I handle, but I can find somebody that can do it if you need somebody out there to do it. Those are like bank statements to qualify, no rent or no income with just rent, things like that. All the stuff that Dodd-Frank said, nope, you're not doing it anymore. Remodel loans, usually, really we see more FHA than we do the home style. It's basically, they can borrow the money just like a construction loan, and they have to put 3.5% down on the repaired price once they get to that price. We don't see a lot of them in this market either, simply because a lot of our things that need to be repaired and things like that, we've got cash buyers coming in and purchasing them and rehabbing them. So, all right, so let's talk about the roadmap. We're going to cover all of these: application, qualifying, initial disclosures, initial condition approval, and processing. We're going to start with application. Anytime you guys send me a client, what I typically try to do is get to know your client a little bit. Any loan officer does this, actually. For you guys that are on Zoom that don't use me typically. Your loan officer, the goal is to get to know your client, find out what their needs and wants are, not just take an application. I want to find out what kind of payment they're looking for. I'm going to ask them what kind of house they're looking for, so I can make sure that we're all on the same page when you guys are searching for a house for them. And I will relay any of that information to you guys that I think is pertinent, because I want to make sure that you guys know everything that I know as we go through the process. We're going to get all their information on the application to your work history, then income information, residential history, and then I'm going to pull up their credit report. And I'm going to review their credit report line by line with them so they know what's on. Am I doing something wrong?
No, it's my fault.
There we go. All right, on the application, there's, how many of you guys have filled out a loan application? Has everybody filled one out? So you have an idea what it looks like. It's changed recently. It used to be 4 pages. Now it's 10. So it doesn't really ask for much different information, but it is longer. So we're going to get all their credit, income, and asset collected from them as soon as possible. But I don't typically do that at the application part. What I will do is I'm going to talk about loan options, interest rates, and I'm going to re-verify information to make sure I've got everything the way they want it. Payment structure, everything, down payment structure.
Come on up. Here you go.
Okay, so this is where we really start talking about the process. I take the application, we review the credit, I go over what their income is. I'm gonna ask, how are you paid? If they tell me they make $3,000 a month, I'm gonna say, is that hourly or salary, or you get mileage? What is that? Because all of that goes into what kind of income we're gonna be able to use and calculate. That's important a little bit later. For the automated underwriting system, which is what we're gonna talk about right now, it just really looks at a number. It looks at their credit score, their debt ratio, and their income, and how long they've been on their job and in their house. It requires that we have 2 years work history, 2 years employment history, and an income number in there, and then it looks at the debt. The nice thing is, it gives us a really general idea of, okay, is this loan gonna work? Is it not gonna work? So what I'm gonna do is I structure the loan. I run the automated underwriting system. It will give me an approve eligible, a caution eligible, or a, what did I get? I got one the other day that was like big red flags. Caution ineligible, and then I got one that was refer. And refer a lot of times means refer to an underwriter. But usually we can get them approved through the automated system. The nice thing is when we do that, what that does is it takes all of that information that I just gave you and it evaluates it and gives us an approval. The underwriter then is going to go through and read that approval line by line, and they're going to verify that the income is what I said it was and what the borrower said it was, that we have the credit history that's required, and we don't have maybe a bankruptcy that didn't show up, or credit lates that are going to affect it. That a lot of times if we have credit lates, the automated system doesn't recognize that, but what it does recognize is, hey, you need to verify the credit. So the underwriter will come back, and we'll talk about conditions here in just a minute. And they'll ask for more information as far as we need to verify what these lates were from. It's pretty easy. After we do the upfront underwriting, I'm going to gather all that income documentation and asset documentation from the client and send it to the underwriter. At that point, your client's going to get initial disclosures. I will usually send them a loan quote before this, but they're going to get the official loan quote in their initial disclosures to sign online. Those are required to be signed within 3 days. You'll notice the 3-day trend here as I talk about that a little later. But it's important that they do that, because if they don't, I have to send them all to them and they have to sign this big stack of papers manually, and it's no fun. It's almost like closing your loan initially. Let's see, so underwriting. So I talked about the fact that I've gathered all that documentation, asset documentation, everything else. I'm going to back up just a little bit because I skipped assets and I apologize. We talked about income and different levels of income. Where assets can come from is just about anywhere except the word cash. Okay, as long as I can document their assets and show that, we're fine. Where we run into trouble is people moving money around. I had a client the other day, unfortunately, she's like, I don't have enough money in this account to cover what I need to for my escrow deposit, so I had to move the money from here to here. And I'm like, that is absolutely fine. However, I have to show that money in one account, I have to show it coming out of that account, and then I have to show it in another account. And where that comes from is Dodd-Frank, and the ability to pay. We have to be able to show that your clients have the ability to pay based on their money, unless it's a gift. Now, if that money is a gift, it's a whole different situation. We're going to verify where the gift funds come from and verify them going into the account. Now, the easy way around that a lot of times is we verify where the gift funds come from, and then I will have them wire that money directly to title. That way there is a direct transfer. We don't have it coming out of one account, coming into another, and then writing another check. The least amount of movement we can have in money, the better off we are. And I actually printed this per hand just a minute ago. And I will give each one of you guys a copy of this, and I'll send it out to you guys on Zoom. It's a do's and don'ts list. One of the things that it says, don't move your money around, because we have to verify that money. We have to verify those funds. Any questions about that at all? Because that's a big one. That is one of the ones that I run into a lot, where people pulling money out of one account and moving into another. All right, so underwriting. The underwriter is going to review the automated underwriting file They're gonna review the client's income, asset, work history, credit history, and debt obligations, just like we just talked about. What they're going to do is they're going to issue an initial approval. This is your actual full underwriting approval. And I say that it's conditional. And the reason it's conditional, and you heard me mention those words earlier, is they're going to say, this loan is approved. I need you to verify this information, gather this piece of documentation, and verify this information, whatever those may be. A lot of times, if we have a good clean file, it's a letter of explanation about where you lived previously, because all of your addresses are listed on your credit report. Sometimes it's, we need a verification of employment from your employer because your pay isn't, we can't really discern how you're paid on your paycheck. And I'm kind of going into detail a little bit more on those because it's important, because a lot of times your clients come to you and they're asking for all this information. And just understand that all we're trying to do is verify that information that's on the automated approval and that they've provided us on their pay stub. The easiest way to do that a lot of times is a verification form. I have, as far as documentation goes, I have a credit situation where a bankruptcy did not show up on a gentleman's credit report, but when we pull up there's a new system called Data Verify that we put each client's name in, and it pulls up any information about that client, and the bankruptcy didn't show up. No problem, he still qualifies, we just have to get a copy of the bankruptcy, underwriter requested it. And it's just things like that that come up. Those are the conditions. One of those conditions, as you guys know, is the appraisal at this point. That has been in our market a hurdle lately. Have anybody experienced that yet lately? That's good if you haven't. But anyway, back to home appraisal can be ordered at that point. We're going to order it as soon as possible. The initial approval, the underwriter reviews the application, determines the credit decision, issues the conditions list, and provides it to the processor and the loan officer. At that point, we order the appraisal. In this market, we order that appraisal as soon as possible because they're extremely delayed. Processing. So my processor is fantastic. I will say that. He actually works off of dates, which I've never seen a processor do. If I don't have everything, or my client, our client, doesn't have everything to him in 7 days, he is asking me for help. So what that means for you guys is we took the application, I sent you a pre-approval, I gathered the documentation hopefully within about 48 hours. I sent it in and I have a complete conditional approval within 48 hours, okay? So now we're up to what, 5 days? You guys are out shopping for houses. We get that conditional approval. He wants all of his documentation in his file completed 7 days after that. So let's say we actually submitted it the day you sent me the contract. We're still talking 12 days and we want your file done, if possible, rather than waiting on anything. The only thing we want to be waiting on at that point is appraisal and title. So he submits it at 7 days. Underwriter usually underwrites it in 48 hours. So at 9 days, our goal is for your file to be done. I will tell you, the number he sent me was 72%. That's about what happens. That's usually pretty average because clients are trying to gather information and get it to us and can't get it to us sometimes on time. But my point there is we really want to make sure that your files are done and able to be sent to closing well ahead of time. Does that make sense? That covers kind of the processing piece. At that point, he's also ordering the title insurance, the flood certification. What else? If there's mortgage insurance on the file, we have to order that through the mortgage insurance company, and working back and forth with the title company to get all the title documents in, and then later on figures. All right, processing. I kind of just went over that, but anything else that is required, we talked about verification of employment. We don't see a lot of verification of rent or mortgage anymore. The only reason I think we might see that coming soon is to strengthen the file. If we can show that somebody has good rental or mortgage history that may not be on the credit report, that can strengthen their file if they've got some credit issues. Again, title, homeowners insurance, condo documents. They're going to collect any outstanding items from the client, just like I just talked about. Then he's going to send it back to final underwriting. Hopefully, they're going to sign off on it and get us a clear to close status. At that point, it's gonna be sent to the closer and they're gonna get with your title company and start sending figures back and forth to balance the settlement statement, so they're done. My goal is to have that done minimum 5 days prior to closing, minimum, if we can. Rarely do we have them bump up against closing. We've had a couple because we've had title issues and things like that, but not too many. So closing, they're gonna initial the closing disclosure. Remember me mentioning that 3-day mark again? This is super important and I usually am right on top of this. As soon as the closing disclosure goes out to our client, I'm gonna call them and say, your disclosure is there. I need you to review it, make sure it looks like it should. Now, typically, we overestimate on all of our loan quotes initially and the initial loan estimate. My goal is for your client to always say, oh, I didn't think it was gonna be that little. Usually it's a couple $1,000s less than we had estimated initially, which I love. Loan gets clear to close, title company and closer balance out the HUD and are done. You can tell how long I've been doing it because it's no longer called a HUD, sorry. Final closing package is issued. Client signs the final closing package and the loan funds. Now, this says once signed, closing funds can be ordered. We actually do that a little bit different. We actually send funds morning of. So we don't wait because with the wire transfer system through the Fed, it can take a while and your client can't get keys until it's funded and recorded. So we pre-wire and handle any discrepancies after that. Loan funds enters recorded and closed. Everybody gets paid. That's all I got. It's pretty simple. Sounds a whole, I wish it was that simple all day, every day. What do we got, Tori? What do we got?
Back to the VA loans,
Yeah.
what are the benefits of having the second VA loan? And obviously, the first VA loan benefits are you can get in without any down payment or very minimal down payment. What other benefits can you get?
He's not gonna have mortgage insurance. He's gonna have an upfront mortgage insurance, but it's gonna be, it's actually more than the 1.75. When you use your second, it's been a while since I've done a second one. It can go as high as 3.6, but usually I've seen like 2.65. That can be financed though, so it doesn't come out of his pocket. And then there's no monthly whatsoever. So that's a good option for a vet if they can use it. The key is they do have to have the eligibility left in that. Any questions on the chat room?
Not so far.
No? Okay. Yeah, sure.
I heard that convention loan, what's it called, the mortgage insurance, right? 2 years, right?
No. If you keep the loan, yes. There can be some limitations on it. However, in this market, we're not seeing people keep them anymore because they're gaining so much equity so fast. Does that make sense? They're refinancing the loan.
What do you mean keep for the, keep the loan?
Yeah, if they kept the loan and they wanted to just request it be removed, they would have to either be at 2 years or I believe they can have an appraisal. I'll confirm this for you. I believe they can have an appraisal done and show that they are at 80% value.
So we can pay the 2 year one time, so we can separate for the 24 months. For the insurance.
Are you asking if you can pay it up front?
Yeah,
No,
you have to pay
it's monthly.
monthly,
Yeah.
the insurance, right?
Yeah.
The mortgage insurance.
Mhm.
You see the, after 2 years, we have to do the appraisal thing.
Well, no, they will
The
actually,
value.
they'll look at what it appraised at. If you don't do a new appraisal, they'll look at what it appraised at and see what your equity is based on the payments that you've made. If you paid the loan down below 80% of the home's value,
Yeah.
then you can request it to be removed.
That's the minimum amount of time. 2 years is minimum.
I believe she's correct about that.
Unless you refinance.
I haven't actually worked with anybody that's done that, so I would have to confirm it. But typically within a 2 year period, you wouldn't have paid it down unless you made some significant extra payments. Anyway, so you would either need to have it appraised or refinance it. The difficult thing for now is if rates don't stay this low, refinancing it, you're gonna raise your rate and negate the value of doing that in the first place. So in that case, you would probably want to have an appraisal done, show, hey, house values have significantly improved. Can we please have this removed? But I haven't done that for a client, so I don't want to put that out there that's the right thing to do and how to do it. Where do I see the wheels turn?
On the, what was it, QM, like the odd loans and whatnot,
Non-Q1.
non-QM? Do we as realtors fall into that category?
A lot of times, because your benefit, so you're self-employed. So you're gonna take every deduction that you can. There's a double-edged sword there. You take all those deductions and you don't pay the taxes, but when we show those tax returns to an underwriter, they say, well, they don't make any money. So the non-QM type loan is what you're looking at. There's bank statement loans, things like that.
So when's the best time to buy a home as a realtor, then, like right after you close a house kind of thing?
No, because we've got to have 2 years tax returns. So we're gonna look at a 2-year history. And see what your history is. And again, it's that double-edged sword. Pay all your taxes and, be able to show that income, or take those deductions and keep all that money and not be able to qualify. Does that make sense? Yeah. Yes, ma'am?
How long for the government loan? How long, for 35 days?
For a FHA loan?
The government, yeah, the government.
Well, actually, we can close just about all of our loans in 30 days. The jumbo loans do take a little bit longer, so we ask for 45-day contract loans.
They jump.
So you can do 30 right now.
I've been doing 30, so let's back up to that, because I mentioned appraisal earlier. Our biggest hurdle right now is appraisals. I have one, we ordered the appraisal. Our contract close date is October 14th. He's actually doing the inspection on the 21st of September and telling us he'll deliver the report on October 15th. So at that point, we had to request a rush and pay an extra $150. Our appraisers are just so busy, and I think this is the way it is all the way around the country. I'd love to hear from everybody else who's on the Zoom call from outside of Reno. Let us know if you're seeing that kind of stuff too. So we want to get the appraisals ordered as soon as possible. And at that point, everybody involved understands that that is the one thing that's out of our control. In this particular case, they, both agents agreed to move the appraisal waiver date because there's not really anything that we can do. We're going to get the appraisal on the 8th instead of which normally it would have been like the 30th, right? And we'd had 2 weeks, but in that case, we did not. So that's the thing that I caution you on is, especially if you're doing a loan outside of Reno or Sparks, Gardnerville, Fernley, stuff like that, those are taking even longer because there's very few appraisers in those areas and they don't want to go out there. The Reno appraisers don't want to go out there because it takes too long. But that is our biggest hurdle right now, and unfortunately, it's one that's out of our control. But I have yet to accept a closed at this point, because I've had borrowers that were willing to pay the extra $200 to the appraisal. I actually had a borrower in Gardnerville that paid $1,200 for this. Just insane. But it was a little bit of a unique property, and we needed it done quick.
So I mean, the government loan is Nevada was called the government. Nevada house last?
Oh, are you talking about the bond loans?
Yes,
Unfortunately, I don't do those.
you don't do that?
No, I don't do any type of bond or grant loans, unfortunately.
I have one piece of this.
Again, if you don't have a lender that does those, I know of 2 that do them really well. Really well.
Do you mind talking about those for a minute, just so we know that there's an option out there? I don't even know what it is.
The bond or grants cover a lot of the down payments and closing costs. Because I don't do them, I don't know the specifics of them. They usually do have income restrictions. You've got to be at 80% or at 85% of the median income for the area. Luckily, that's still a pretty good amount in our area. But there's one out there for teachers. I do know that. The terms of the loan, I don't think are quite as good. as a standard loan. But they are getting free money, so you weigh those options.
First responders included with that?
I'm not sure. Anymore, I would sure hope so. You know, there's gotta be a program out there that does cater to that. My only concern is first responders make really good money at this point. A lot
And
of times.
USDA, it's that balance between your income.
Yeah,
any
and the
income
house.
that you just.
And the house. Yeah. It's- Go for it, guys.
Can you talk about the remodel loans? Is
Yes.
there a loan to value and today's value versus remodel value? How do you determine that?
You do the loan based off of the remodel value. They have to put, on an FHA, they have to put 3.5% down on the remodel amount. Here, let's just go back. I've done,
Oh, I got it. There you go.
I've done a couple of them, but it's been a couple of years, which is why I want to go back to this.
Is there a minimum?
Your minimum is, you're not gonna hit your minimum around here. Your minimum would be whatever the lender usually has, and it's probably gonna be 100, somewhere around there. All right. Remodel, okay. Limited up to 35,000 on the standard 203K, unlimited as far as what the loan, the remodel cost can be on the unlimited. Sorry, limited is 35, standard is no max. This one I've never seen done, but I guess it could be done. Complete tear down, as long as the foundation works. Can't imagine what that would entail. And you just rebuild the house on the land at that point. There you go. Although I don't know that you would fit into the income limits here, because the landing incline would cost more than what you would,
Yeah.
the loan limit. 3.5% as repaired value. They must use a 203K consultant if they do the limited up here, because that is a very limited amount, and they want to make sure that somebody knows what they're doing is following the bids and the draws and everything else. Not required on the standard. I've never done a home style. Again, this is where your loan limits are a little greater. Up to 95%, 97% of at least one borrower was a first-time home buyer. That's a good option. Owner occupied second home and investment can be structural or cosmetic. That is not a program I've ever done. It probably isn't very difficult though. I will tell you they've done such a good job going through these rehab loans that they're really kind of seamless in how they're done. They're done just like construction loans anymore. When they first came out, I was with Wells Fargo and it was a nightmare. I mean, it was just trying to get bids and get everything done correctly. It was hard. I've actually talked to a couple of guys who do them a lot now, and they're just like a regular. There's just a couple more steps, so they're not.
Is it FHA 2 or 3K, is that only for owner occupied?
Yes, yeah, that would be the difference there.
How many years? 30 years?
30,
So what's the rate?
I have no idea, Shelley. I would have to look and see. I'd happy to.
But it's higher than.
It'll be a little higher because it's a little more, there's a little more risk in the loan. And that's where your rates come from. Is how much risk is there? Credit, income, assets, down payment. That goes into everything. This side of the room's been kind of quiet.
So the.
Sponge, we're being a sponge.
So the remodel loan, we need to do the appraisal.
No, yeah, there will be an appraisal just as, and the appraisal will be done as repaired per plans and inspections.
After repair.
Plans and specs, sorry, not inspection.
So after repair, the appraisal, don't they look at the remodel, right? After finish, right?
Well, we're going to get an appraisal based on plans and specs, and then they will have to do a final inspection to make sure that that is actually what was done.
So what's mean after job finish, appraisal, don't they check it out?
They make sure that it was done according to the plans that they were given in the first place when they did the appraisal.
You have to pay 2 times appraisal?
There's gonna be an inspection fee, it's normally about $100,
Okay.
so it wouldn't be a full, another report, they just like on new construction.
Yeah.
When we send an appraiser out, they go out and inspect the property, they say, based on the plans and specs, this is what the house will appraise for, then they go back right before it closes, do a final inspection.
Kind of re-inspection, right?
They just go out and make sure it's done, essentially.
So how's that work, especially in the rehab, where costs can either come under, hopefully under, but over, or like either way?
Well, I mean, they're gonna inspect it and do the appraisal based on what it should appraise for, based on it being rehabbed with the area and the comps that are there.
I'm gonna follow up a little bit.
Okay,
Yeah.
You go to them, you didn't-
So the two types on the 203K, so there's two types of renovation loans available, 203K and home style. And two types of the 203K, that up to 35,000. If I was doing those loans, I'd be like, okay, let me borrow this 35,000 or 25,000, redo my kitchen. And then have that inspected and then take another 35,000 and then go redo all my bathrooms in the master bedroom kind of thing.
no, you probably couldn't do that. I mean, I guess you could, it would not be cost effective. You'd be better off coming down here.
Okay, and so the home style is a much larger loan than both the standard.
Well, on the standard, you can do whatever loan amount you needed to. So there's just two different types. And I apologize, it's been quite a while since I've done a 203K. It's been about actually 10 years. I just know that this one has a few more restrictions, that's why it's limited, right? You're not doing structural things, you're more doing cosmetic, you know, changing bathrooms, changing your kitchen, stuff like that. The unlimited will allow for structural. That's why.
All
That's more like
three, some- 203K is sale price, what's that?
That's the type, that's just the name of the loan.
And Brian, I mean, I think I know a little bit about those loans, but on those loans, you as the owner, you still have to pay up front and then get reimbursed, right? And that, no,
They're draws. They're draws,
Now, is this just FHA? You do it on a VA loan or anything like that?
just FHA.
Just FHA.
So it's actually, the loan is actually closed and then the amount is set, just to clarify. So it's not like you don't close on the loan and you just go out and repair your house and then you close on it. The loan is based on, okay, we're gonna do these repairs. We have this contractor who's approved by FHA. We're going to close the loan. You then draw the money from the loan and pay the contractor, just like you would a normal contractor, on draws at each section of the bill being done. Then the appraiser is gonna go back out and re-inspect, make sure everything was done. And actually, in this case, the consultant on the limited goes out and inspects the property. I do know that. At least that's the way it used to be.
If you wanted to make repairs as an owner builder, you'd have to go home style.
I don't know that you would be able to do it as an owner builder. I believe you have to use an approved contractor to do it. That's, and again, guys, I apologize. This is not one that I specialize in. I've done a couple of them. It's been a few years. And at that point in time, you had to use an approved contractor.
So convention loan cannot do the.
No, there's a conventional option right here. Yep.
So so this remodel loan for any type of home, right, like invest home. like-
Down here for the conventional, yes, owner occupied second or investment.
Oh,
Up here, owner occupied only.
oh,
Guess I need to brush up on my 203K because it sounds like you guys like them.
question that you have the.
that's how the room does anyway.
What's that?
That's how the room does.
Right, exactly.
So if we do the loan, like a FHA loan or convention loan, so the loan process 30 days, 35 days. Appraisal already done after 20 days, 25 days. So on the after appraisal, then the lender called and said, hi, your buyer cannot approve the loan, you know.
No, they close the loan before any construction is done.
No, I don't talk about this case, I talk about another case.
Oh, okay.
So that means appraisal, we already paid, the buyer already paid the appraisal fee by credit card. And after 30 days, the lender called me, the buyer said, hi, your buyer failed the loan now go through, so with the appraisal 500 go back to my buyer now.
Unfortunately, in that case, it wouldn't, but
It depends.
I'm not gonna say that I've never in 20 years had that happen, because people do things that they shouldn't do during the loan process. And I'm gonna, what's that?
Buy a car?
Buy a car, stuff like that. Right, buy an RV. But the idea behind the way we do our process is that your loan is approved by the underwriter based on the conditions before we order the appraisal. And what happens in that process is when the processor and myself get the conditions, we're gonna call your client and send them an email and review those conditions with them and say, how soon can you get me this information? At that point, we should all be on the same page and know if you can't provide this information, or if this information is incorrect that we've provided the underwriter, we shouldn't be ordering the appraisal.
I think the appraisal order earlier than, after the application, because you want the order earlier.
Well, but not before the approval. That's what I'm saying. The underwriter should have approved that loan based on the conditions. And then the loan officer typically reviews, the conditions with the client before we order the appraisal.
Maybe 80% of that,
No, I would never order an appraisal if I thought anybody
not
was.
talking about maybe review the plan, the documents, said, hi, you kind of qualified, pre-qualified. Pretty sure you kind of loan, that final loan that failed, for some reason that failed, So when you order the appraisal, we had to pay, right?
You do, and that goes directly to the appraiser. It does not come to us.
Yes,
So if the appraisal report is completed, that's been done.
I know they've been done, but the loan that failed,
Why did the loan fail, I guess would be my
I don't
question.
know.
Yeah, and see, that would be my question is,
I have the
Um,
one case.
and I'm gonna knock on something, knock on some wood somewhere. I typically do not have that happen. I usually vet my clients and your clients very extenuously to make sure that we're not gonna get in that type of situation. And
Oh, the loan that failed is not about the loan, it's about, it's not case, it's about the house.
oh, the house
something
failed.
wrong, yeah, it's caused something wrong, my client cannot buy because they didn't tell the truth. So we went to there,
So the house failed the inspection, not the client.
the house not built inspection, the house condition is tenants live there, right? Tenants have the property manager, with his tenants. So we get an offer, we settled, and we ask the seller what's going on, the tenants. Don't worry, they were moved out month by month, right? They were moved out in 30 days.
So they left the house in poor condition?
No, they didn't move out after 30 days. So I asked the seller agent, sorry, he don't know what's going on because the property manager is already signed the new lease for 1 year. In our 30-day loan,
So I'm gonna put myself back in your guys' position, probably ask you guys the advice on this. In that case, I would ask for my earnest money back and possibly even ask for them to pay for the appraisal.
No, we asked the earnest money back, but that's so easy to ask that, but the loan already did, please.
Yeah, that's what I'm saying. I might ask for them to pay for the appraisal.
Yeah,
Seller.
we asked the appraisal back, that the lender said,
No, I wouldn't ask the lender. I would ask the seller to pay for the appraisal.
now the seller.
Yeah, that's a pretty unique situation.
Because their situation is.
So I'm gonna address it from a different standpoint. I'm gonna address it from the standpoint of all of a sudden the borrower doesn't qualify for the loan 20 days in. Unfortunately, if the appraisal report's been done, that's been paid to the appraiser. you can, hopefully you can see the terror on my face when you ask me that question, because to me, that means somebody's not getting a home. And I've done something that I shouldn't have done by qualifying them initially. So I can tell you, I take that personally, and that would shake me to my boots. I just can't imagine telling somebody they qualify for a home and then being in a situation where I say, you know, what, sorry, doesn't work. So to answer your question on that front, I always try to make sure that when we go over that conditions list, can you get this stuff to me pretty quick? And rarely do I have no that I can't, you know. In particular, one of the bankruptcy that I mentioned, the guy's like, it's been 10 years, I don't have that anymore. So bankruptcy is pretty easy. I went to the county records and pulled it up and we're done. So. Yes,
One
ma'am.
thing your buyer can do is probably just a small claims.
Yeah, I would. Which guy?
Can I go back way to the beginning? We have a new buyer,
Okay,
brand new person.
all right.
We bring them into you, so we can get that kind of pre-qualification, so we as agents really know where their buying capacity is. When they get that letter from you, how long is that good?
90 days. Basically, it's until the credit report is no good. Now, what also has to happen in that process, though, is I'm gonna gather their income and their asset information. And as we move along, I have to update that information. That makes sense? So you get new pay stubs, please send them to me. Get a new bank statement, please send it to me. And that's a great actual segue, because here we search for houses for a long time sometimes. One thing that I talk to everybody about, and it's on this sheet here, is don't make any large deposits that are more than your pay stub. You know, don't move money around if you don't have to. Don't change jobs. Please don't change jobs. I did have a guy change jobs in the middle of his approval, and he got a better job, so it worked fine. It was in the same field. But don't go from being a realtor to being a bricklayer. We're not going to qualify for one. But does that answer your question?
So if you go into contract on day 90,
Yeah. We'll pull in.
are your terms locked or do you do news, you redo it?
We'll just pull in the credit report. And typically that's one of the things that we talk about is don't make late payments, you know, make payments on time, don't change anything that you've done in the past. That way, when we do pull your credit report up, your credit is either the same or better usually. One of the things that we do see a lot of times that I work with people on is a credit report is, and most people don't look at it this way, it's a live document. And what I mean by that is the day you pull it, that's your score. The next day, if your creditors report something different, your score is going to be different. I actually have a what if scenario that I do with a lot of clients that, let's say they've got a 629 or 630 credit score, and if we get over 645, I can look at their credit report and see, okay, they've got a credit card that's got a balance of $1,000 and it's got a credit limit of $1,200. I can actually put it in the system through the credit bureau and say, what if they paid that down to $500? And it will tell me immediately what the score is going to jump to. And I actually did that with a client last month, and we improved his rate by an 8, just by him paying down a credit card. The kicker to that is you really have to know when it's going to report to the credit bureau, and just so you know for your own information, that normally happens the day they report it to you. So your billing cycle is normally when it reports. So we like to give it 5 to 7 days after it reports, and then we can pull up a new one. I don't have to pull a new report. I can just re-request that information through it. So it's not a whole new report. But that's been one of the neatest things that I've been able to do with Move Home that I was never able to do before. But the credit bureau that we use, they're fantastic.
On our purchase and sale contracts, on the first page, there's a blank line for us to fill in that says how many days in which the buyer will lock their rate.
Yeah.
First of all, I'm not sure why that's important, just the seller to know. But is there a recommendation from your point of view? Because rates are go up and down.
So let's talk about that. I'll tell you why it's important. Because what if rates jump? And then the buyer no longer qualifies. That's why. So essentially, you've got a pre-approval based on where rates are at today. Let's say rates today are 3 1/8, I think, and let's say they went to 5 tomorrow for some reason. It's not gonna happen. That would change qualification. So that's why that's there. Now, for you guys, you can put 30 days. I mean, knock on wood, all of the experts say through the end of the year at least, if not into 2022, we're gonna stay in the 3s. What that means, that could mean 3.99, but we're still gonna be in the 3s. I'm gonna go to Michael on that. Is there any other, as an agent, that you see that needs to be different than 30 days?
No, 30 days seems sufficient. And also make sure you're getting a new one regularly. And then when you do go into contract, have a new one. You know, I see a lot of people will get a new pre-approval for the exact purchase price amount because they're worried that if the seller sees that they're approved for more, they'll ask for more. I don't think that's true at all. You know, whatever you're pre-approved for, feel free to send that with your offer. If you are worried about it, you can get a new one, but I don't think it's
And
necessary.
I'll issue you a new one. I actually, from my standpoint, in this market, you guys aren't offering less normally than ask. So I agree with Michael, and please ask other agents, because I'm not an agent, and I don't negotiate like you guys do, but from just a personal standpoint, if I was selling a house for 400,000, and I saw a pre-approval based on 500,000, and they were offering me 410, I know they're not gonna offer me more than 410, but I see that they're approved for well more than I'm selling my house for. So that's the way I look at it. I think that's kind of what you're saying.
Mhm.
But that being said, I totally also understand not wanting to give away the phone, right? You don't wanna show your hand if you don't have to. So anytime you're doing that, you need a pre-approval. You guys know that. That's, you know, I've sent stuff to me. I'll issue it immediately. I issued one at 10:30 at night during the rib cook-off, as a matter of fact. I got a call. He's like, "Hey, can you do this?" I'm like, "I'm at the rib cook-off right now. Can you get it later?" He's like, "Yeah, that's fine." But yeah, because he was presenting an offer the next morning. So I'm gonna go back to rates and talk about that a little bit. I actually think I skipped over a bullet point. One of the things that I will do with your client is I will never recommend they do anything but lock. I will tell you that. As an experienced loan officer, the worst thing I can do is say, you know what I think the market's gonna do? It's gonna get better. Because what if it doesn't? Nobody's got a crystal ball. Hedge your bet, take the lock. I usually like to lock for 37 days instead of 30. Gives us a little bit of leeway in case something goes wrong with the property, or for some reason the loan gets delayed. But especially in this market, 3% is almost free money. There's not much difference between 3 and 3 1/4.
And how long does it take you to lock? Like if you're,
If I'm on the phone with them, I do it right there. Click. And I can do that up until 6 PM my time every day. So,
is that the same for refinancing as well?
the rates are usually a little bit different, but the lock, yeah, I just push a button. And I get an email that says, we received your lock request and it'll be on the way.
If the rate drops,
The rate drops,
but you're locked in at that
you're locked
level.
in. Yep. Now, go ahead, Shelley.
So you lock 35 days or 40 days?
He does those.
I usually try to do 37. Unless your contract is 45, I'll go by what your contract says.
So
That's one of the things that-
How long a period you can lock? 60 days?
How long can I lock?
Yeah.
I've had a 6-month lock before.
So.
It's because it was a build job.
So what
Okay.
in this case, you lock 40 days after, 40 days, we are some situation, you have extension the close date. Close extension for another 5 to 10 days,
We can extend the lock, but there is a cost to the client.
how much is that?
I believe it is 1/8 for every 7 days. So 1/8 of a percent. So for every
8% what, sale price, or loan price?
loan price,
Ooh.
not
So
8,
that's
1/8.
why-
So if rates go down during that extension and their lock expires, you can get that rotary?
It's always worst case scenario. I've got one right now that it's a build job and we did lock based on what the builder told us, and our lock is gonna fail. So he's not gonna be able to close until October 16th, and our lock expired at the end of September. Happens a lot in this day and age because, oddly enough, everyone on my build jobs hasn't been able to get the cabinets in. I don't know why it's just cabinets, but that seems to be.
Because the manufacturer were closed.
So they couldn't know them.
I guess, but in this case, rates really haven't changed, so we're just gonna hedge and let that lock expire. And then we'll start talking about, and he'll get worst case scenario, and if worst case scenario is exactly what he had before, that's what it is. If rates go down, I think he's at 3.25, rates go down to 3 1/8, he's gonna get 3 1/4. So you're not gonna be in a worse situation in that case unless they do go up. Does that make sense? Yeah.
When you do the extension, the lock, so it's extension for 10 days, the buyer had to pay the 10 days for the
Yeah,
the extension.
so if we know you're gonna extend for 10 days.
Yes, but your lock.
We're gonna have to have a 14-day extension, so it'll be, that'll be a quarter.
I know, 14 days, we need to pay the lock, buyer to pay the 14-day extension or not, pay the longer rate, the lock extension.
Yeah, the buyer would have to pay the extension.
Oh, thank you.
Yeah.
That's the
Now,
rate.
here's what you can consider, depends on who's requiring the extension. The seller's requiring an extension, make them pay. You know,
Oh, depends.
if you can negotiate that, you make them pay.
I know, but I did it one time, 1 day, 100.
100 days.
No, 1 day that the buyer pay the longer extension, 1 day, 100,000.
We can, usually if we do one extension and we need a day or two, we can do that, but typically they require the first one be a 7-day. Because we know what's gonna happen eventually, unless we know that we're gonna be 1 day off, we know it's gonna be a couple of days before we get funded and everything.
You see the buyer in the 8%, 8% loan
1/8.
amount,
Yep. Point 125.
going 1.
Keep them coming. While we're here. Jess, what questions you got?
I don't even know where to start.
Well, we start with the application, so whenever you're ready.
What is mortgage? Do you need an
You need an agent.
Faster.
Be careful what you wish for. That was good, guys. That's what you're supposed to do. Have I covered everything that you hoped I would cover?
Yeah.
Is there, I mean, I know sometimes you don't know what you don't know, but have I brought up anything that you thought, I didn't know that, I'd like to know more?
I do have one question.
Yeah.
One agent, an agent owner who's social media I manage, she gets a lot of questions about, what the mortgage process is like if you have an ITIN.
Okay.
Does Muslim Nevada Mortgage work with people with ITINs?
We don't, but I do have a lender who does a great job.
You do?
And Laura might even have a lender that we could recommend them.
Okay, all right.
But unfortunately, I really don't do a lot of the things that are outside of the normal spectrum, and
I see.
that's one of them.
Okay.
What's an ITIN?
Here,
Oh.
what's an ITIN?
ITIN, those are, persons that are in the United States and they have permission from the government, to work, but they're illegal.
They don't have social security numbers.
Exactly, they don't have cards.
Oh,
Like for example, where
In my case, all of my clients have to have a social security.
so you case, the
50% of mine
requires
are-
this security numbers, right? How about the people who have green card?
Same situation.
Yeah, they have the ITIN.
They have the ITIN.
Oh,
Yeah.
so the rate is high?
I don't know that the loans are that much different. It's just a different type of loan.
Yes.
There are. It is, trust me, it's one that I wish I could do because there's a lot of business out there, but unfortunately I have to turn away.
I've heard.
But at the same time, my goal is to be efficient for you guys and make sure that we're profitable for you guys. So I'm here in the long run. So that's kind of why the bank of loans that we have selected, they allow me to do both of those things. Does that answer your question? So how about if I do this? Let me know who that is,
Okay,
and I will make sure and find, I actually have somebody that I know here in the building. that
okay,
I-
yeah, because there are a couple agents
Yeah,
here who.
there's several.
Yeah, who have a lot of
That's why I'm taking Spanish classes.
clients.
That's why once you pass, I can use you.
Yes,
Yeah.
I am trying. I found out that, the local college does a 4-hour Saturday class every Saturday. I've got a friend of mine who's taking it. I'm like, I wish I would have known that. I would have jumped all over that. But
What's more important than the Spanish classes, the specific mortgage vocabulary? You just learn the vocabulary and have a basic understanding of
Yeah.
Spanish. Yeah.
But if you get an actual person with no accent, speaks.
we
real
actually,
good-
we are working on that.
Yes.
Just so you know,
please.
we are working on at least having somebody who can come in and help with the
Yeah, because
process.
you mentioned you talked to the client over the phone, you have somebody in Spanish, bam.
Right, yeah.
And once you do that, let me know immediately.
Yeah, my goal is, and you guys are really helping with this, as I mentioned, as much as we're growing every month. When I get to the point where I can hire an assistant, it's gonna be a Spanish speaking assistant. So we've talked about that in this. So, because we wanna make sure to support you guys that need that.
What am I'm missing a piece where I don't understand what. this-
A lot of Juarez clients speak Spanish.
I'm sorry,
A lot of my clients speak Spanish
because you do?
because they feel more comfortable speaking with somebody that speaks their language.
Well, of course.
So they'll trust you more and,
And this is a big trust
Yeah.
process.
oh yeah, being the biggest purchase of their life, they want somebody.
Right, I just didn't know that
Yeah,
you
that's
spoke
fine.
Spanish.
Oh,
I mean, that was
Yeah.
where I was going, that
Yeah.
sounds like.
Yes, it
I
does.
do speak Spanish and French and Italian, but we don't really have French and Italian.
Beautiful.
And most of my ESL students are from Mexico
Yeah.
and
I,
some Peru and Ecuador, but mostly, and from Haiti.
I know enough Spanish to get me in trouble. That's all.
So, but I do have
I know a lot of
students that.
You know that too, don't you?
All right, for example, last night, in fact, my student Jose, he said his goal is to buy a house.
Right.
So, they're at an intermediate level that I'm teaching over at TMCC, so it's kind of curious to hear what you were.
So while we're on that subject, I will share a story that I have cried one time at a closing. And it was an assistant of an agent of mine's family who had moved here illegally from Mexico. They had saved $50,000 over 10 years. We did a no credit loan for them through FHA. They had zero credit. We established all of the credit. And they bought a house. And that was the loan right there.
Well, good cry.
I pay cash for everything, so that's why I won't credit.
Right.
And I tell them, Bill, but they're always paying cash for everything.
It was the most difficult loan I've ever done, but we hammered it and got it done. It was awesome. I don't have anything else, guys, if you don't, but, well, actually I do. I have one other thing. I am always here to help you with any questions that you have, just like we were in here today. One thing that those of you who do call me, I hope all of you do, but that have, know that I try to answer my phone at any point in time that I possibly can. Because I know that you guys work different hours than the normal 9 to 5. My job is to work for you and do everything I can to make sure that your clients love you. So please give me that opportunity and call me for anything that you need, anything at all.
One last question, since we do have people across the country, can you do loans across the country?
I wish,
Only in
just
Nevada.
licensed in Nevada, unfortunately. But hopefully they have a loan officer who works for them as hard as I work for you guys.
You send us that rural area map?
Yeah. Rural area, no.
Yeah.
Just shoot me. Just
Thank you,
type it
Brent.
over.
You're very welcome.
Thank you.
Yes, and thank you for lunch.
Yes.
Thank you, Tori.
We're just-
Ladies and gentlemen, Billy Adams.
Hey, do you have that CPA contact? that I can use?
Yes, Dave Masterson, Tax Partners.
Here.
No.
Go ahead.